Welcome back to the deep dive, where we cut through the noise and really get to the core of what's happening in the numbers. Today, we're diving back into the financial charts, the ledgers, specifically for one of the automotive giants, General Motors.
That's right.
It's Q2 2025, and their latest earnings report, well, it offers a really fascinating, almost paradoxical look at the current economy. We've got sources painting a complex picture, big hits from tariffs, but also some surprising beats on earnings and a shifting road ahead for their EV plans. Our mission,
Yeah.
help you understand what's truly important here. This is your chart ledger deep dive.
It really is a classic case of navigating some pretty turbulent waters. What's fascinating, I think, is that on paper, GM delivered some positive news, but then you look at the market reaction and it has a bit of a different story.
Right, that disconnect.
Exactly. So we'll explore that disconnect, look at the strategic moves GM is making and, what it all means for them and, frankly, the broader auto industry.
Okay, so let's unpack that first big challenge then. The Trump tariffs. They're really making their presence felt, aren't they?
Oh, absolutely. A major headwind.
So explain the direct financial hit. Our sources show GM's net income dropped, what, 35% year over year?
A 35% drop. Yeah.
Yeah.
And a huge piece of that, $1.1 billion, was a direct profit hit just from tariffs in Q2.
1.1 billion.
Yeah.
Just in one quarter.
Just in Q2. It really underscores how directly these trade policies impact, the corporate bottom line. It goes way beyond just the top line revenue numbers.
Yeah.
Their adjusted operating profit, for instance, that fell 32% year over year, down to $3 billion. So real pressure there.
And this is just looking backwards, right? They warned it could get worse.
That's right. They expect the burden to worsen in Q3, and they reiterated their full-year estimate. That's $4 billion to $5 billion impact for the whole year.
Wow. Okay, so it's no wonder the market reacted. Shares dropped pretty significantly,
Right.
about 6–7% after earnings.
Yep. That immediate reaction was quite sharp, largely pinned on those tariff concerns, even though, as we'll see, there were other positive signs.
And the stock's actually down for the year now, as of late July 2025, down about 4%.
Precisely. And it really shows how much that future uncertainty, that tariff overhang, is weighing on investor confidence right now.
And it's not just GM feeling this, is it?
No, not at all. Stellantis also warned about a significant impact. I think it was 300 million euros in just the first half of 2025 for them. And Ford shares fell too. It's an industry-wide issue.
Okay, but here's where it gets, really interesting. Despite those tariff headwinds, GM actually showed some surprising strength. They beat analyst expectations.
Right. This is the paradox.
Yeah. So adjusted earnings per share, EPS, came in at $2.53. That beat the Bloomberg consensus of $2.33 and also LSEG's $2.44 a bit.
Beating both estimates, pretty solid.
And revenue, too, $47.1 billion. That also beat Bloomberg's estimate of $46.27 billion, even though revenue itself is actually down slightly year over year.
Right, down just under 2%. But beating the expectation is key here. And if you connect that to the bigger picture, it shows that core business strength is still there. Demand for their traditional vehicles is holding up.
Especially in the U.S., right? Sales were up.
Yep, U.S. vehicle sales rose 7% year over year. That's about 746,600 units. And overall sales were 974,000, up over 7% year over year globally.
And specifically in those profitable segments, pickups, SUVs.
Exactly. Strong demand and pricing for light-duty pickups, full-size SUVs, and crossovers. Those are their cash cows, basically.
Okay. And what about China? That market's been tough.
Well, another positive sign there. GM actually swung back to a small profit in China. They reported sales growth for the second quarter in a row after losing money there a year ago.
So a potential turnaround.
It suggests things might be stabilizing for them there, yeah.
Yeah.
And analysts are noticing this underlying resilience. Citi's Michael Ward, for instance, noted GM seems prepared for the worst-case scenario, so maybe there's potential for some upside.
Right.
It's crucial, especially when you consider what Tom Narayan from RBC Capital highlighted, this weird market dynamic where even companies beating earnings see their stocks sell off because of broader investor worries.
So GM's core strength is kind of pushing against that negative sentiment.
Exactly. It's quite remarkable, really.
So, okay, what does this all mean for their strategy, They're not just sitting back and taking these tariff hits, are they?
No, definitely not. They're actively working on a mitigation plan. The goal is to offset at least 30% of that expected tariff burden.
30%.
Through some pretty significant manufacturing and supply chain shifts, basically bringing more production home.
Okay, like investing in the U.S.
Precisely. A massive $4 billion investment in U.S.-based assembly plants.
$4 billion. That's serious money.
It is. And it's aimed at adding capacity, about 300,000 units of production capacity for those key vehicles. Pickups, SUVs, crossovers.
And they have a timeline for this.
Yeah, CEO Mary Barra stated they expect to build over 2 million U.S. vehicles annually within the next 18 months.
Wow. That's ambitious.
Very. It involves specific investments in plants in Michigan, Kansas, Tennessee. They're moving Cadillac Escalade production, boosting pickup output, even moving the Chevy Blazer production from Mexico to Tennessee.
So a big shift away from Mexico, sounds like.
It's a significant move towards localization. You know, right now, GM imports about half the vehicles it sells in the U.S., mostly from Mexico and South Korea. Ford, by contrast, makes about 80% domestically.
Oh, okay. So GM is trying to catch up on that front, maybe future-proof a bit against these trade issues.
Exactly. It addresses the tariffs, yes, but it also bolsters their core profitable combustion engine operations, which, you know, given the current market, seems like a pretty pragmatic move.
Okay, pragmatic move on combustion engines.
Yeah.
Let's pivot now to the future, right? Electric vehicles, EVs. GM has huge ambitions here,
They certainly do. They're North Star, as they call it.
but they're hitting some speed bumps. Now, on the plus side, EV deliveries nearly doubled, up 111%, about 46,300 units in Q2.
Huge growth in volume, yeah, about 16% of the U.S. EV market share in the quarter.
But there's always a but, isn't there?
Well, yeah. Despite that growth, the profitability of the EV division is still, let's say, uncertain. There's more competition, and overall consumer demand for EVs seems to be slowing down a bit.
Slowing demand. And policy changes aren't helping either, that federal tax credit.
Right, the $7,500 federal EV tax credit, which has been pretty vital for affordability, that expires at the end of September. It's a big deal.
And something about fuel economy fines.
Yeah, the elimination of fines for not meeting fuel economy rules, the CAFE standards, that effectively makes it, well, less costly or perhaps more appealing from a pure profit standpoint to produce more gas-powered vehicles right now.
So the incentives are kind of shifting away from EVs, at least in the short term.
It seems that way. Barclays analyst Dan Levy noted these changes mean EV profitability is probably going to get a little trickier. It's harder to achieve profitability through scale if sales growth is slowing and the policy supports are weakening.
Makes sense. But what's GM saying? Is Mary Barra backing off the EV goals?
No, she reaffirmed the commitment, said she's very bullish on where we're going to be on EVs in the next couple of years, and committed to profitability on every model, but importantly, without giving a hard timeline for that profitability.
Oh, okay. So committed, but maybe acknowledging the timeline is a bit more flexible now.
That's how it sounds. It's this complex dance, you know, balancing the long-term vision, that EV North Star, with the immediate market conditions and policy realities.
It really feels like a tightrope walk.
It absolutely is. And analysts are noting this broader market trend, automakers shifting focus slightly back towards bolstering their profitable gas truck and SUV lineups, while EV growth moderates. It's about funding the transition.
Right. Using the profits from today to pay for tomorrow.
Basically, yes. It's not abandoning EVs, but perhaps recalibrating the pace based on what the market and policy will support right now.
So, okay, let's wrap this up. What does this all mean for you, the listener watching GM in the auto world? It was definitely a mixed bag for GM in Q2. Revenue, profits down mainly due to those tariffs. That cast a shadow.
For sure.
But that underlying business, especially U.S. sales, was strong. Beat expectations, showed real resilience.
That core strength is undeniable.
The stock dropped nearly 7%. That reflects the near-term uncertainty. Tariffs, EV policy shifts. It's a lot to digest.
Absolutely. The market is pricing in that risk.
But GM's long-term strategy, that EV push, even if adjusted, plus this huge $4 billion U.S. investment, that could be key to navigating these headwinds, right?
Potentially, yes. It shows they're making big strategic moves, not just reacting quarter to quarter. It really highlights how even a giant like GM has to perform this intricate, sometimes contradictory dance between dealing with today's problems and building for tomorrow.
A complex dance indeed.
Yeah. And I think the big takeaway here is how external factors, tariffs, policy, consumer shifts can really dominate the narrative. Even when a company technically beats earnings estimates, it makes you question how much weight to put on just one quarterly report versus those longer-term strategic investments and, you know, a company's overall adaptability.
Good point.
So maybe the question for you to think about is, What stands out most from GM's situation? Is this tariff trouble just a temporary storm they can weather with these investments? Or does it signal a more fundamental, maybe permanent shift in the challenges facing global automakers today?